Welcome to Algorithmic Trading Decoded, where we unpack strategies, models, and market impacts in a practical way. In this presentation, we'll move from the origins of program trading to modern machine learning approaches, highlight execution mechanics, infrastructure, risk controls, and regulatory implications, and show how these pieces combine to shape market behavior and trading edge. This slide traces the evolution from 1970s program trades to today's machine learning models, showing how electronic exchanges, decimalization, and co-location lowered costs and latency. As models evolved from simple TWAP and VDOAP rules to statistical and predictive ML systems, big data feeds and microstructure exploitation became key enablers for alpha generation and faster decision-making. Here we compare core execution algorithms. VDOAP times trades to historical volume profiles. TWAP slices orders evenly over time, and POV targets a percentage of live market volume. The visuals show how slicing and timing aim to minimize slippage, reduce market impact, and hide trader intent, turning a large parent order into many smaller, less disruptive executions. This page outlines three strategy families: statistical arbitrage that exploits historical price relationships, momentum approaches that follow sustained trends, and mean reversion tactics that bet on price normalization. The diagram emphasizes using diverse data signals like order book events, sentiment, and volatility, while continuously retraining models on rolling windows to adapt to regime shifts and preserve performance. Achieving sub-100 nanosecond speeds requires specialized hardware and tight engineering. Co-located servers, kernel bypass NICs, and FPGA chips are combined to shrink round-trip times, enabling microsecond market making and latency arbitrage strategies. The flowchart illustrates how these speed differentials let firms capture small, risk-managed profits across extremely short time horizons. This diagram shows a high-throughput ingestion pipeline streaming tick-by-tick market data, news sentiment, satellite imagery, and IoT feeds into Kafka clusters for aggregation. From there, GPU-accelerated backtesting engines perform outlier cleansing and feed normalization, so models receive consistent inputs, ensuring reliable downstream model consumption and faster iteration on new data sources. Before any order hits the market, automated pre-trade controls verify position limits, validate order size, enforce price collars, and apply fat finger filters. The flowchart shows how these checks route orders for server exit if they violate rules, preventing erroneous trades and mitigating regulatory fines while preserving market stability and operational discipline. Real-time performance monitoring combines live dashboards for P&L, sharp and drawdown analysis with automated risk controls and circuit breakers. When thresholds are breached or volatility spikes, triggers reduce positions and log actions, while predefined risk budgets enforce losses per strategy and asset class, ensuring losses stay within limits through proactive, auditable interventions. Algorithmic trading can improve market efficiency by narrowing bid-ask spreads, increasing depth, and lowering transaction costs. The slide maps continuous quoting and deeper markets to reduced price impact and lower institutional transaction costs, which in turn supports better price discovery across venues, benefiting a wide range of market participants and asset classes. Algorithms can amplify market moves through positive feedback loops and correlated exits, which in extreme cases contributed to events like the 2010 flash crash. The mitigation side highlights circuit breakers, regulatory scrutiny, and kill switches as tools to pause or halt trading. The balance between innovation and systemic stability is a recurring theme requiring coordinated oversight. Looking ahead, deep reinforcement learning brings adaptive agents that learn hidden regimes and optimize strategies via continuous reward signals, while emerging quantum techniques promise faster models and richer alternative data integration. Together, These approaches aim to push alpha frontiers by exploiting new opportunities and improving order placement through advanced optimization. Regulatory imperatives demand surveillance, comprehensive audit trails, and fairness metrics to ensure market integrity. Real-time monitoring, bias detection, model interpretability, and performance attribution support oversight and transparency. The goal is to prevent manipulation, ensure model accountability, and maintain investor confidence while allowing responsible innovation in algorithmic trading.